Kitco News special coverage of the 31st Global Metals and Mining Conference is brought to you by Gold Terra.
Hello, I'm Michelle Makori at the Bank of Montreal Global Metals and Mining Conference, now in its 31st year. And the titans of industry have gathered here in Hollywood, Florida. And joining me now is one of them. Pierre Lassonde is the man that essentially created the gold royalty model. He is the co-founder of Franco-Nevada, the first publicly traded gold royalty company. And Pierre has also served as president of Newmont Mining and as chairman of the World Gold Council. And he is currently the CEO of Firelight Investments. Pierre, so great to have you with us here at the BMO conference.
Well, Michelle, thank you so much for having me. It's always a pleasure. And I think I've been at this conference actually for the whole of 31 years.
Wow, a veteran of the conference indeed. All right. Well, I would like to start off with something that has cast a shadow a little bit over this conference. Even though it's great to have people back in person, we do have this looming threat of how the Russian-Ukraine situation escalates. Obviously, it's a tremendous humanitarian disaster, but it also presents a lot of geopolitical risk, which creates market risk and extensive volatility. Now, granted, you are not a military or political analyst, but you are a student of history, as you've mentioned. And of course, you're a very worldly, sophisticated man, traveled around the globe. And your instincts have served you very well in the past. So I'd like to get a sense from you on how you're reading the dynamic at the moment. How do you see this playing out?
Well, I think that Mr. Putin calculated that this was going to be an easy, quick win for him to just roll into Ukraine and essentially, put it back into Humpty Dumpty, put Humpty Dumpty back together, which is what he was trying to do. His plans are not turning out exactly as he had wished. And with the Germans now changing tack and saying, no, you know what, we're going to provide military help, that has, I think, changed the possible outcome of this war quite dramatically. But the longer it lasts, the more profound the impacts are going to be, particularly on the energy market. And if this goes on for, 2-3 weeks, a month, I think you might be looking at $200 oil and like $7-10 gas. And you're going to see also, because of the sanctions you've seen on the Russian banks, they're going to have great difficulty. You're going to have a lot of bankruptcies. So it's going to roil the markets something fierce.
$200 oil, very much a possibility in your mind.
Yep.
Let's see where we are right now. Obviously, this is a rapidly developing situation. But as you said, Putin is a little bit surprised by the resistance that he's facing from Ukraine. Arguably, that makes him more dangerous. There is nothing more dangerous than a wounded, caged animal. Do you see that then perhaps escalating the situation? I mean, how does he walk back from this? Is there a scenario where Putin now says, all right, I give up and withdraws his forces? I don't see him walking back with his tail between his legs, unless he gets some dramatic diplomatic concession, which unlikely will happen, or he escalates it to a level where there's some kind of standoff. How do you see that playing out?
Russia has the veneer of a first world nation with a third world nation. He doesn't have a whole lot of forces he can commit to Ukraine that are prime with, the battle ready and great equipment. So he cannot outlast the Germans. He cannot outlast, NATO if NATO gets involved. Where it goes from here, it's anybody's guess.
Right.
That it's impossible to predict.
Are you factoring the potential of a nuclear escalation? He has threatened that he has put his nuclear forces on alert. Is that something, and I know I'm asking you to speculate wildly here, but is that something that you think is really within the realm of possibility here?
I don't think so. I think that Russia, just like the US, has to have generals who are level-headed and saying, we're not going to destroy our population because you want to go have Ukraine. and which would be the same thing if Biden decided to launch the nukes, and he's got generals there that have a second key and say, hey, you know what, that's not going to happen. So I'm not that concerned about at this point anyway.
Okay. But you do see this being a protracted conflict, given the resistance we've been seeing from Ukraine and the support from countries like Germany now, at least in terms of supplying military assistance. So what does that mean for the mining sector? You're predicting $200 oil. What does that mean for the mining sector?
Inflation. Unfortunately, when you look at mining costs, 25% of the costs are related to energy. And Russia is 10 million barrels. It's 10% of the world supply of energy. So it would have a huge impact on the market. And it would mean that in the short term, any mining company that is not hedged production forward at like these current prices, they would see, quite a bit of inflation in their costs.
All right. So that brings us back to what it means for gold in this environment. If we have high inflation and still geopolitical risk, and potentially the Fed not being able to take as aggressive tightening action as it said it would, what do you see gold doing?
Oh, that's an easy question. Because what I see today are shades, I call them shades of the 1970s. So we are seeing the same pressure today on inflation as we saw back in the 70s. And what's changed everything, Michelle, is really the pandemic. During the pandemic, we had all these frontline workers that we say, you saved our day, you did the incredible, task for the nation, and they were getting paid $9 an hour. And all of a sudden they're saying, if we're that good, why are we getting paid $9 an hour? Why aren't we getting paid what we are really fairly, should be valued at? And last year, 4.2 million Americans quit their job because they were not getting paid what, so the amount now today that the Amazon of this world and the Walmart have to pay is like $15, $16, $17, $19 an hour to attract anybody. And as you know, wages don't go back down. Okay, once they get up there, they don't go back down. So we're going to have wage inflation. We're going to have energy inflation. So again, in the 1970s, from 1976 to 1981, you had inflation going up every year. You had interest rates going up every year. You had the dollar going up every year. And guess what? You had gold going up every year. And that's what you're going to see for the next 4 years.
So gold going up.
Yep.
For the next 4 years, do you have a price outlook for gold then in this environment?
I think medium term, I could see easily 22 to 2,400. And I think it's probably going to go much higher than that in about 4 or 5 years' time when you see inflation keep going. People still, the narrative out there from most American banks is, this is transient. Don't worry, it's going to go back down. And if the dollar goes up, gold's got to go down. No, this is the old narrative. This is the narrative on transient inflation, on inflation's going to go back down. This is not what's going to happen.
Well, look, last time we spoke, we did discuss this notion that inflation was transitory, as Fed Chair Jerome Powell was insisting that it was. You said, no,
Nope.
Absolutely not transitory, not transient. But given the situation that we're in now, does the Fed have any tools to really counter inflation? We do have the Fed meeting March 15th. Initially, it was projected that we'd have a 50 basis points interest rate hike. Unlikely that we're going to get that now in this environment. Perhaps a 25 basis point hike. What's your prediction for the Fed's next move in this March meeting?
It doesn't matter. It doesn't matter. The Fed is in a box. They have 20 trillion of debt. They cannot raise interest rates more than 1% or 1.5% without putting the economy back in the toilet. They have nowhere to go. Mr. Powell has to be like, he has to feel like a porcupine in a balloon factory. Okay.
Good analogy.
All right. Like, he cannot move. And it doesn't matter because the real rate of interest, which is really what matters to gold, is going to stay deeply negative for the next 4 years, which is exactly what happened in the 1970s. You had inflation running 8-9%. They jacked up interest rate to 3%. You had minus 4% real rate. Interest rate went up to 16%. I don't think we're going to see that in this environment. There's no way we are able to see that. But the reality is that inflation at 7% and interest rates at 1 or 2%, that's deeply negative interest rate, and gold is going to fly
So gold is going to fly to where in 4 years' time?
much higher.
Give me a price.
You know, it's not inconceivable that you see gold in the $3,000 to $5,000 range.
Within
Not
4 years.
inconceivable at all.
So why hasn't gold really rallied so far? It has moved a little bit, but considering the fundamentals, as you quite rightly point out, are all in place, why are we not seeing this reflected in the price of gold at the moment?
Well, the pandemic essentially shut down the physical gold market. India and China in particular are huge physical buyer of the gold, and those two countries ended up shutting down during the pandemic. Now, the sales are coming back, but it made a big dent in the physical market. At the same time as the narrative in the US is, interest rate goes up, the dollar goes up, and gold's got to go down. And so you've seen the hedge fund slam gold every time there is a rumor that interest rates are going to go up. So that narrative has to change, and it is changing. I think a lot of, hedge funds are starting to work their numbers that it's going to be different. But until that narrative change, gold's going to have a bit of difficulty, going back up.
Well, let's factor in the strength of the dollar in this environment, because obviously you've got the dollar-gold relationship. And right now, the dollar is strong because we are seeing a flight to safety because the dollar is still being perceived as a safe asset. Do you see that changing, especially when you look at the big picture here? And many would argue that the US's status as a superpower has been diminished by the conflict in Russia, which was started perhaps by the way, or Russia perhaps was emboldened by the way the US handled Afghanistan, and that this could also then spiral into perhaps China taking a move into Taiwan, seeing what many are saying has been perceived as weakness on the global stage by the Biden administration. You combine that with, as you mentioned, the unprecedented monetary and fiscal stimulus, soaring inflation. Does this then mean that the dollar's days are perhaps numbered as a global reserve currency?
The answer is yes, but probably not in our lifetime. Okay, because it's still the biggest, market in the world. And where else are you going to put your money? There's a euro. But what's Europe going to look like? Look at the Ukrainian war. How's that going to affect Germany? How's that going to affect the rest of Europe? So the euro is, a little suspect. Then you've got the pound. The pound is a very small market, and the yen, and that's it. You don't have the dollar is still the only global currency out there. So you can dent it, you can, pound it, you can do a lot of things to it, but it's still the global currency.
Well, Pierre, some of our other analysts on this show and interviewees would say Bitcoin. Bitcoin is the other alternative here. What are your thoughts on that? As a global reserve currency, if you will, that Bitcoin is poised to replace the dollar.
Yeah, unplug your computer and what do you have? Nothing. Okay, Bitcoin is a mathematical equation in space. That's all it is. There's nothing fundamental about it. There's nothing, gold has a deep physical market. Every day people buy the stuff, okay? Bitcoin is...
But we're not saying that the dollar is replaced by a gold standard. The argument from the Bitcoin maximalists would be that the dollar is replaced by a Bitcoin standard because Bitcoin can be used as a currency.
Well, yes and no, because the way that at least the way I understand it, Bitcoin has a fixed number of equations you can resolve and then it stops. So if your economy keeps growing, you're stuck with a number, and what you then end up doing is deflating your economy to be able to stay with the amount of currency available. So in the long run, it's untenable. There's not one country that would ever use that because it's untenable.
Well, many of our analysts would say otherwise. Perhaps we'll have you on to debate them. That would be a very colorful conversation because you do have the argument that you've got the Satoshis, which are the divisible elements of Bitcoin. But let's get back into something that I know you have been very bullish on, because it's clearly not Bitcoin, and that's copper.
Yeah.
Last time we spoke, you said that the best mining option is anything that has a copper deposit, a copper gold deposit, or a copper gold silver deposit, or a copper silver deposit, but something with copper words. Are you still that bullish on copper?
Yeah, I am. And copper is, at the end of the day, if you want a green world, it's the only metal that will provide the green world because it carries electricity. And everything runs on electricity. So without copper, you don't have any transportation, you have no communication, you have no air conditioning, you have, no elevators. You don't have a modern civilization. And to be able to decarbonize, you have to end up with, 75, 80% of our energy, terminal energy, has to be electricity, which means a lot more copper.
All right. Well, on the copper point, copper reached an all-time high of 4.9 in May of last year. It's around 4.6 now. Why is copper dropping then, considering it's so set up to be so essential in a decarbonized world?
Well, copper follows a construction industry, and with China slowing down on the construction side, you can see the demand softening up. So, but there's no new copper mine coming into production. I mean, the problem with copper is very simple: is that you need to put a giant deposit in production every year for the next 20 years to be able to meet the demand that's projected. So we don't have them. We haven't found them yet. So I see copper being between like $3.50 and $10 a pound for the next 20 years until a new generation of copper mines come into production.
Okay, so $10 copper by when, Pierre?
Oh, I think we're going to see in the next generalized booming economy. First you got a little war to resolve. What's going to happen with Europe? So and I think the next turn is probably going to be 2006, 7, 8. In that time frame, I would not be surprised. Then you get to start a bit of replacement with aluminum. So it's not going to last, okay? Because at $5, $6 a pound, aluminum becomes interesting for some applications, like air conditioning, for example.
Okay, well, let's circle back to the war that's currently happening and the impact that that could have on this move to decarbonize. Because many are suggesting that this may be a wake-up call, that this push against fossil fuels has been a little too aggressive, that perhaps certain administrations need to scale back their aggressive move against oil and gas, particularly in the United States and in Europe, where strict regulations have been applied to these industries. Do you see this situation, if oil hits 200, as you mentioned, perhaps re-incentivizing investment into oil and gas and perhaps leading some of the Western administrations to rethink this push towards net zero emissions?
I think there will be there is a day of reckoning with the greening of the world. And the problem has been very simple. There's been no real planification of how do you get to zero. People think, or you hear, well, we've got the science, we've got, a wind farm, we have a solar farm, and we can make it work. The reality is that when the wind doesn't blow and the sun doesn't shine, you have no electricity. And yet you still want to use your air conditioner, you still need your elevators to get you up to your 30th floor apartment. So what do? Then you duplicate all of your infrastructure to be able to meet, because the batteries we have are not good enough to be the buffer zone between the farms, whether it's the solar or the wind farm. So we need much better planning, and you're going to need more gas in particular for base load electricity, and because that's your least damaging option until you come up with green options that flow seamlessly to the consumer.
So then you do see perhaps a reversal in the aggressive way that oil and gas companies have been targeted in terms of regulations. You do see some of these countries, including the US, pedaling back a little bit on that?
I think you will see that. I mean, there's 1 billion cars that are in circulation today that use petrol. And those cars are the main asset in many, many cases of the family. You're not going to get rid of them in 5 years. Like, these cars are going to last a long time. And you need to have the petrol for them. They're using it to go to work. Or, the French. Why did you have the yellow, the
Vest part, yes.
Yeah, because they raised taxes on petrol for like five euros. Well, forget it. Like, people just went to the street.
So do you see this then impacting the decarbonization trend and impacting all the metals that are expected to soar as we move away from fossil fuels?
No, I think long term, the trend is there. That's not going to change. What's going to change is in the short term, there's going to be a realization that maybe the mix was not right. Like, why did Germany shut down their nuclear plant? Now they must be very sorry, okay? The French never did. The French get 80% of their energy from nuclear, and they're going to add more. So in the short run, I think there's going to be a realization that maybe we have to do much better planning. We maybe need more, gas plant for base load,
right,
more nuclear, but long run, the decarbonization is still there. It's still going to happen.
Just more of a balanced approach.
Yeah.
All right. So how does an investor then take advantage of this trend? How would you recommend getting exposure to copper for starters? Through equities, ETF, royalty companies? What's the best way to play this rising copper trend?
Well, in copper, there are a number, the copper business is controlled essentially, 80-90% by 5 large companies. So if you want exposure to copper, you have only, frankly, very few choices. You can buy a copper ETF, which is fine, or you can buy one of the very large BHP, Rio, Glencore, the very large First Quantum, which is 100%, or, here in the U.S., Freeport, okay?
Right.
And if you're a little more adventurous, you can look at some of the more junior intermediate companies that are coming up with small, high-grade deposit. Like I'm involved with Foran, for example. They have a deposit up in Saskatchewan, very high grade, but it's going to be a small, intermediate type, very high impact for the shareholders. But it's not going to make a mark in the world of copper. Okay, in the world of copper, you need $4, $5, $6 billion investment because that's what these mines cost.
Right.
So they're only affordable by the really large companies.
Okay, so let's circle back to gold, which you are extremely bullish on at the moment. What is the best way to get exposure to gold as an investor right now? What would you recommend?
My recommendation for most investors is you own a bit of the gold ETF. You split your portfolio 3 ways. You own some of the gold ETF, you own royalty company like Franco-Nevada. To my mind, they're the safest, best way to have exposure to gold, apart from the bullion itself. And then you look at the equities themselves, and then you can decide whether or not you want to be in the very large market cap company or the intermediate company. The reality is that in the gold business, where most of the money is made is the intermediate company, because they all end up being acquired.
All right. Well, what about physical gold? Do you advocate holding physical gold?
Yes, that's the no-brainer option, okay? But as Warren Buffett said, if you don't know what you're doing, diversify. But if you do know what you're doing, concentrate. So for the average investor, diversification is the way to go. Bullion, royalty company, and equity. For someone who really knows what they're doing, maybe they want to be in gold bullion with options and strike price and calls and, collars, and they can do a lot of things with it without having to be in the equity business. So it depends who you are.
Okay. It's always subjective. Very quickly, you did once say that you do see the Dow gold ratio hitting 1-to-1, as it happened, I believe, in 1930 and in the 1980s. How do you see that scenario happening again? How does that play out?
That's a very interesting scenario. The Dow today is like 35, 6,000. So we're nowhere near 1-to-1 ratio. And it's also instructive in the 1930, the Dow lost 90% of its value, so gold only went up double.
Right.
In 1980, it's very different. The Dow actually lost early on 40% and then tack on 20%. So it went from 1,000 down to 600 back to 800, and gold went from 35 to 800. This time around, I think if the Dow loses 20, 30%, maybe, but there's so much money around, I'm having a hard time seeing the Dow losing more than that.
So you don't think we're going to hit Dow gold 1-to-1 ratio? You're taking that prediction off the table?
2-to-1?
2-to-1.
2-to-1?
So that's your new prediction, Dow gold 2-to-1 ratio?
Yeah, I think we could see 2-to-1. Yeah.
And that's more about how the Dow has soared and less about the value of gold.
Yeah, but at 2-to-1, with a 30% pullback, you're looking at 10,000.
Yeah.
That's doable.
2-to-1 gold to Dow ratio. And I'm going to ask you by when?
No, I think next 5 years.
Wow, next 5 years.
Yeah. And if you'd asked me that same question 2 years ago, I could not have given you an answer because I could have never predicted the pandemic.
Sure.
I could have never predicted the trillions of dollars that have been created out of nowhere and look at you straight in the face and say, oh yeah, we're going to see 10,000. You ask me why, I wouldn't have known. Now, when I look at inflation, when I look at the amount of money that's being put directly in the pockets of the consumer, and I look at what's happening with real estate prices, with inflation in general, with wages, yeah, it's like shades of the 1970s, and I can see it happening.
All right. Well, I know I've asked you to address a lot of known unknowns, as well as no-knowns and unknown unknowns, as Donald Rumsfeld would say. So I appreciate you prognosticating with me here. Thank you so much for joining us, Pierre Lassonde. Always insightful talking with you. Appreciate
Thank
it.
you, Michelle. Always a pleasure seeing you.
All right.
Thank you.
Kitco News special coverage of the 31st Global Metals and Mining Conference is brought to you by Gold Terra,